Environmental analysis is a critical component of ESG investing because it helps investors assess how environmental factors may affect financial performance, operational resilience, and long-term value creation. Environmental issues such as climate change, resource scarcity, biodiversity loss, pollution, and environmental regulation can influence risks and opportunities across companies, industries, and economies. To evaluate these impacts effectively, investors employ a range of analytical approaches that examine environmental factors from different perspectives and levels of aggregation. These approaches include company-level, project-level, sector-level, country-level, and market-level analysis. Together, they provide a comprehensive framework for understanding environmental exposures, sustainability performance, and future investment implications. Company-level environmental analysis focuses on evaluating how individual firms manage environmental risks and opportunities. Investors examine factors such as greenhouse gas emissions, energy efficiency, water consumption, waste management, pollution controls, environmental governance, and sustainability strategies. Company disclosures, sustainability reports, regulatory filings, and third-party ESG data providers are common information sources. This analysis helps investors identify firms that may be vulnerable to environmental liabilities, regulatory changes, or resource constraints, while also highlighting organizations that demonstrate strong environmental stewardship and innovation. Company-level assessments are frequently integrated into valuation models, risk management frameworks, and portfolio construction processes to support informed investment decisions. Project-level and sector-level analysis provide additional perspectives on environmental performance and risk exposure. Project-level analysis evaluates specific investments such as infrastructure developments, renewable energy facilities, mining operations, or industrial projects. Investors assess environmental impacts, permitting requirements, resource dependencies, and climate-related risks that may affect project viability. Sector-level analysis examines environmental issues that are common across industries. For example, utilities face carbon transition challenges, agriculture depends heavily on water availability and biodiversity, while extractive industries encounter resource depletion and pollution risks. Understanding sector-specific environmental drivers allows investors to compare companies more effectively and identify industries that may benefit from or be challenged by environmental megatrends. Country-level and market-level environmental analysis evaluate broader environmental conditions that influence economic performance and investment environments. Country-level analysis considers factors such as environmental regulations, climate vulnerability, resource availability, pollution levels, biodiversity management, and sustainability policies. These considerations can affect sovereign creditworthiness, economic competitiveness, and investment attractiveness. Market-level analysis examines systemic environmental risks that influence entire financial markets and economies. Climate change, environmental degradation, and resource scarcity can affect multiple sectors simultaneously, creating market-wide risks and opportunities. Investors use these broader analyses to assess macroeconomic sustainability trends and support strategic asset allocation decisions within global investment portfolios. A key aspect of environmental analysis involves evaluating environmental risks through carbon footprinting and other carbon metrics. Carbon footprinting measures the greenhouse gas emissions associated with a company, portfolio, project, or investment activity. Common carbon metrics include total emissions, emissions intensity, carbon efficiency, financed emissions, and exposure to carbon-intensive sectors. These measures help investors understand climate-related risks, regulatory exposure, and alignment with low-carbon transition pathways. Carbon analysis has become increasingly important as governments implement climate policies and investors seek to assess transition risks. Carbon metrics provide quantitative tools for comparing environmental performance and monitoring progress toward sustainability objectives across investments and portfolios. Two advanced approaches increasingly used in environmental analysis are the natural capital approach and climate scenario analysis. The natural capital approach recognizes that ecosystems, biodiversity, water resources, forests, and other environmental assets provide valuable services that support economic activity and business operations. Investors evaluate how companies depend on and affect these natural assets. Climate scenario analysis examines how different future climate pathways, policy developments, technological changes, and economic transitions could affect investment outcomes. By modeling alternative scenarios, investors can assess resilience under varying environmental conditions and identify potential vulnerabilities. Together, natural capital analysis and climate scenario analysis provide forward-looking insights that strengthen ESG integration, risk management, and long-term investment decision-making.